Hey everyone, welcome back to Corporate Decoder, where we take complex corporate filings and make them easy to digest. This time, we're diving into Bally's Corporation's latest financial report, and let me tell you, there are some major shifts happening. So buckle up because we're about to decode community, linked in the description below to keep the conversation going. Okay, let's get straight to it. Bally's Corporation, as a global gaming, hospitality and entertainment company, has been busy. Looking at the balance sheet as of June 30, 2025, we see total assets nearing $7.8 billion. That's a big jump from roughly $5.8 billion the previous year. A lot of this growth comes from property and equipment, which has more than doubled, and intangible assets also seeing a significant increase. This tells us they're investing heavily in new properties and perhaps acquiring more brands or technologies. Now let's talk about the money coming in. For the 3 months ended June 30, 2025, total revenue was about $652 million in the same period last year. This growth seems to be driven by their casinos and resorts segment, up over 14%, likely boosted by their merger with Queen. Interestingly, their goodwill, which essentially represents the value of a company, over and above its identifiable tangible and intangible assets, has seen some movement. It decreased from about $1.8 billion at the end of 2024 to $1.72 billion by mid-2025. This could be due to accounting adjustments or perhaps the amortization process. A significant development we're seeing is their investment in the Star Entertainment Group. On April 9, 2025, Bally's funded a substantial amount in convertible notes and subordinated debt. This is quite a strategic move, and they're accounting for these instruments at fair value. Their balance sheet shows that these investments and other items are valued using level 3 inputs, meaning they're based on unobservable data and management estimates. This is typical for these kinds of complex financial instruments and deals, but it does mean there's a degree of estimation involved in their valuation. We also see the impact of their past deals, like the Sinclair performance warrants, which were initially treated as liabilities but are now being reclassified. It's a reminder of how past agreements continue to shape their current financial picture. Let's look at the debt situation. Their term loan facility is significant, totaling over $1.87 billion as of June 30, 2025. They're actively managing their exposure to interest rate and currency risks using various financial instruments. They also issued 11% senior secured notes due in 2028, totaling $500 million. This represents a substantial amount of debt, and the interest rate is quite high. Delving deeper into their segments, the casinos and resorts revenue is strong, showing about $93 million for the most recent quarter. This is boosted by the addition of the Queen properties. However, their North America Interactive segment is showing growing pains, with revenue up but still operating at a loss according to their adjusted EBITDA figures. Now let's look at their profitability measures. Adjusted EBITDA, which helps to understand operational performance by removing certain expenses, shows their casinos and resorts segment is bringing in a healthy $106 million for the quarter, but the international interactive segment, while showing improvement, is still a significant contributor. The international interactive revenue saw a slight decrease compared to the previous year, which they attribute to the sale of parts of their international business. Meanwhile, North America Interactive is growing thanks to their iGaming and sports betting expansion. A big chunk of their expenses goes to general and administrative costs, which increased significantly, partly due to merger costs and the integration of new properties. This is a critical area to watch as they integrate these new businesses. Depreciation and amortization expenses have decreased, largely because they closed down their Tropicana Las Vegas property, which had a significant impact last year. In terms of other income and expenses, they reported a notable gain from the fair value of their intralot investment, which helped offset increased interest expenses from higher borrowings. The tax line item shows a huge provision for income taxes for the successor period. This is mainly due to the way they're carrying forward certain tax assets related to interest expenses, and it's a complex area. Overall, Bally's reported a net loss of $28 million for the quarter. For the first 6 months of the year combined, their net loss is even larger, reflecting the significant costs associated with their recent merger and ongoing investments. Looking at where the money is going, capital expenditures are substantial, especially for their future Bally's Chicago permanent facility, which is a major undertaking. They also have significant ongoing commitments for property and leasehold improvements. The merger with Queen Casino Entertainment Inc. is a huge focus here, accounted for as a transaction between entities under common control. The preliminary allocation of the purchase price shows significant goodwill and intangible assets being recorded. The valuation of these intangible assets, like gaming licenses, customer relationships, and developed technology, is complex, using methods like the Greenfield method and relief from royalty method. These rely on significant estimates and projections. On the liquidity front, Bally seems to have managed its cash flow reasonably well, with sufficient balances and revolving credit facility availability to cover its needs. However, their debt levels remain substantial. The company has a significant amount of unsecured notes, including their 5.625% notes due in 2029 and 5.875% notes due in 2031, which represent a considerable long-term financial obligation. Their commitment to Bally's Chicago is massive, with plans to spend at least $1.34 billion on the project. This is a critical long-term investment that will significantly shape their future. A major upcoming event is their transaction agreement with Intralot, which is expected to close in the fourth quarter of 2025. This deal is substantial, valued at around 2.7 billion euros, and could see Bally's become a majority shareholder in Intralot. This is a really interesting strategic play that could significantly alter their global footprint. Now, on the control side, management acknowledges a material weakness in their internal financial reporting, specifically concerning the segregation of duties in their international interactive segment. They are actively working to address this, including implementing a new ERP system, which is a positive step. Scroll interest rate risk is. When we look at market risk, interest rate fluctuations are a key concern, given their significant debt load. A 1% change could impact their interest expense by over $21 million. They are actively using derivative instruments to manage this risk. Scroll foreign currency risk, mainly from their UK operations, experiencing a few $1 million in transaction losses related to currency movements. So what's the verdict on Bally's? They're undeniably in a period of significant transformation, marked by major acquisitions and strategic investments. The merger with Queen and the planned Intralot transaction signal a bold ambition to scale and diversify. However, this growth comes with substantial debt and complex accounting, particularly around intangible assets and fair value measurements. Their general and administrative costs are also ballooning with these integrations, and the material weakness in internal controls highlights the challenges of managing such rapid expansion. While the casinos and resorts segment shows resilience, the interactive divisions, especially North America Interactive, are still finding their footing and becoming profitable. The company's direction is clearly towards a more integrated omni-channel gaming future, but successfully navigating the financial complexities and execution risks will be key. Alright, that's our full breakdown of Bally's latest financial report. What do you think about their aggressive growth strategy and the challenges they face? Let us know your thoughts in the comments below. If you found this analysis helpful, please hit that like button and subscribe for more deep dives like this. And don't forget to join our Discord community linked in the description to continue the conversation and connect with other viewers. Thanks for watching, and we'll see you in the next one.